Hi, I'm going to talk now about ethical investing or ESG investing because every year we see more interest in it and we think there are a lot of misconceptions and there are potentially ways that people have accessed it which are quite dangerous for the average client in our opinion. I'm going to cover that in a little bit of detail. So the main issue with ESG is that you're naturally constraining the investments that you can make in order to achieve the desired societal impact that you want. But it leads to lower levels of diversification and higher risk. And that is very important that is managed because poorly managed risk can lead to very bad outcomes for clients. So there are three areas in which this is an issue. The first is many people consider government bonds to be unethical. This is a very niche view in our opinion, but it's based on the fact that defence spending can lead to harm. Most government spending, of course, is not directed in that area, and many people would also consider defence spending not inherently to be unethical. In our view, government bonds are also very important for portfolios because they are the only asset that is truly risk-free and goes up during recessions in many cases when other assets go down. So if you remove them from a portfolio, you greatly increase the risk, and we think that is a mistake. Secondly, the ethical constraints quite often drive people to invest predominantly in the US and Europe and ignore the rest of the world. Again, this reduces your diversification and reduces a major area that fund managers can add value to clients by timing investments in different parts of the world. So it both reduces your potential options for return and increases risk. So if you don't have government bonds and you're very overexposed to the US and Europe, we think there's two areas of problems there. And the last area, which is probably even more significant, is that if you're not careful, you will end up changing the type of companies you invest in, particularly in the equity market. So you'll invest in things which are commonly in the market known as growth investments. So investments which are expected to grow very quickly, but they're very expensive and people are expecting that growth already in the price that you pay. Versus a lot of the investments that you'll exclude will be in the area of what we call value. So old, established, traditional industries which are relatively inexpensive, pay high levels of dividends, but people aren't expecting high growth. Now, people sometimes believe, wrongly, that growth investments will outperform value investments, but that is completely untrue. Throughout history, you have periods where growth investments do well and periods where value investments do well. And if you only hold growth investments, you are condemning your portfolio to long periods of poor returns. I can't state that too strongly. And you're removing a lever from your fund management to use their expertise to try and smooth out returns and improve them over time. So implementing ESG in a way where you only buy growth style investments is a mistake, especially as we've had 10 years of growth style outperformance and we're well overdue a swing towards value. The best way, or really without saying it too strongly, we think the only sensible way for most clients to implement ESG is to start from the basis that every sector in the global economy is likely to continue for the foreseeable future. And the way each sector is managed is of importance. And if we want to maximize societal impact, we should try and ensure that we are influencing within sectors. This means that we focus on companies within each sector that are maximizing societal benefit using ESG criteria. And we do not exclude sectors simply because they have a lower overall rating for ESG compared to other sectors. So within the traditional energy business, we would find companies that are doing the best to mitigate climate change. And within chemicals business, we'd find companies that are using resources in the most efficient ways to try and minimize energy use. This way of building portfolios allows us to participate in all areas of the world and in every area of the economy and to properly balance risk and to introduce levers to improve returns, and also means that your money will be used to try and influence behaviors within sectors. And we think this is the best of both worlds because it both allows us to maximize truly societal impact as well as allowing people who require returns from their investments to get proper risk control and it'll give us as fund managers the levers we need to try and make the maximum from the money people have and the best returns. As always, today I have been talking about investments, and you must remember your capital is at risk. The topic I've been talking about is quite complex. I've only been able to touch the surface. If you have any questions, speak to your advisor if you've got one, or just contact me directly. I'd be delighted to help you. And if you've enjoyed the video and you don't subscribe, just click on the flying colours icon here and you should automatically be added to our YouTube subscribers list. Thank you.